I'm Michelle Nofel, Head of Distribution. I want to welcome you to our City Different Investments quarterly webinar. From our investment team, we have fixed income co-portfolio managers Chris Ryan and Shweta Singh. From our domestic equity team, we have portfolio managers Rob McDonald and Connor Brown. And from our global equity team, we have portfolio manager Vin Walden and senior analyst Jong Lim. If you have questions throughout the webinar, please feel free to type them in the comments box and we'll address them during our Q&A session. And we'll get started with our fixed income team. So much has happened in the market and fixed income is leading the charge. What are some of the big themes that you're seeing and how are you navigating the market?
Thanks, Michelle. So I recently started reading a book by Ed Helms. It's called Snafu. Now that is a World War II term that stands for situation normal, all fudged up. And I think it's quite an appropriate title for what's going on in the fixed income markets since Liberation Day. Shweta and I have, talked about the three possible scenarios that the tariff regime could bring into the economy. One being that we continue to have stable growth and that unemployment stays low and inflation begins to recede. Second scenario is that we have a recession and that if we have that recession, the Fed will act to counteract recessionary trends, lowering interest rates. Finally, what the Fed broached yesterday was the risk of a stagflation scenario. And we think the probability of a stagflation scenario is increasing. Under each of those scenarios, the performance of our SMAs would be quite different. In the continued growth scenario with inflation receding, you get paid to take duration. And that means you're going to own longer maturity bonds. We do not have that structure in our portfolios at this point in time. We are overweighted to the front end of the yield curve because we think that is the best value. In the recessionary scenario, the Fed will lower short-term rates and we'll probably see what's called a bull steepener. Rates will go down, led by the front end of the curve, and you might have longer rates stay the same or move up just a little bit as investors reassess their risks. Finally, in a stagflation scenario, you'll get what we call a bear steepener. Short rates will go up, long rates will go up by more because the risk premium adjustments that investors demand will increase. Under the recessionary scenario and the stagflation scenario, we think our structure will do quite well. But it'll have a big credit impact, those scenarios. And I'm going to turn it over to Shweta right now to discuss the credit impacts on our portfolios and our strategies.
Sure. Thank you, Chris. And I'll come back to credit, but bottom line, what Chris is saying is, look, there's the hard economic data that still does not indicate a distressed U.S. economy. There are some activities that have been pulled forward ahead of implementation of tariffs. The U.S. consumer is still strong and has found ways to cushion this blow. And we see examples like fractional jobs, gig economy. The economy, though, however, does not appear to be on the precipice of recession, even with financial market volatility that is exacerbating all this fear. The three scenarios that Chris outlined is to recognize, however, that the economy can shift very quickly. Yet, April employment situation report shows very little concern on job front. And given that it is half of the Federal Reserve's mandate, we think that for the Federal Reserve to lower rates, there has to be a weaker job market before we can see any rate cuts. And this is particularly true given the new tariff regime where there will be inflation risk that will persist. And this was unchanged yesterday for the Fed, where you saw rates being left alone at 4.25 to that 450 range. So which side of this mandate will need addressing first? Is it the higher unemployment or the higher inflation piece? Powell said yesterday that both risks have gone up, and it isn't clear, which one will be bigger. So if the two goals are in tension, he said that the Fed would resolve these by assessing how far are they from the goal of full employment and from the goal of the 2% inflation number. And he said, and how long would it take to get back to this mandate? Market expectations after Powell came out and yesterday's press conference is that you went from somewhere around 16 basis points of rate cut for June to now, as of this morning, that's gone down to 4 basis points. We see the Economist surveys that has been submitted to Bloomberg, which shows Fed funds rate anywhere between that 450, which we see today, to 325 for the end of the year. And, now that we're counting, but there is 5 Fed meetings left for the remainder of the year, so plenty of room for the Fed to take action. And Fed funds future implies somewhere between 50 to 75 basis points of rate cut by the end of this year. However, there's a very low conviction number attached to that. The 10-year Treasury yield, now that has remained range bound between 410 and 460. To us, that indicates that the market does need to see hard data turning negative for that to move, as well as for the Fed to move. Now, as promised, on the credit front. So let's tackle IG credit first. The bottom-up read from first quarter earning has been strong, supported by that much-wanted pull forward we saw in consumer spending. We thought that the credit spreads was beginning to look interesting, but it quickly reversed. And this is because of the strong fundamentals of companies with strong balance sheet, good pricing power. Most of the tariff cost will be passed down to consumers. So spreads are still tracking earnings report by companies and have not yet been reflective of tariff uncertainty, neither do they reflect the negative GDP print that we've seen. So for investment grade corporates, this has translated to 112 basis points of corporate credit spread. And that has lagged the equity market rally that we saw. And it's also because in IG corporates, the supply calendar is really robust for end of April and also May, we'll see much more issuance. Chris and I think that this is a great year to be an active credit picker. Sectors that have high percentage of sales revenue coming from within the US with less reliance on, outside the US, with somewhat of a moderate leverage profile should see an advantage in corporate credit. We like sectors like telecom, utilities, and we're staying away from names with large reliance on global markets. Basically, cyclical auto names, for example. Credit quality in our portfolio has been on the higher side, and we are investing in companies with large and liquid balance sheet. So that's sort of our story on the corporate side. On the municipal side, we continue to like muni credits. We think munis are somewhat insulated from tariffs as their revenue source is tied to property tax, basic services like water and sewer, which are counter-cyclical to maybe, the scenario that Chris laid out, recession, stagflation. The biggest part of the state budget is Medicaid expense, with 30% of it being funded on a state level. And we've been staying away from hospitals during that COVID era because of bad debt and now payer mix that relies on federal funding. So staying away from that, but we continue to like cities, school district, water sewers, which are isolated from social welfare program and federal funding cuts. Munis, to give you an idea, muni credit spreads are somewhere around 90 basis points, 200 basis points, grinding plus or minus 10 basis points up and down, which still is pretty tight. Just to give you an idea, long-term average is around 170. Back to Chris to talk about how do we think about investing with all this volatility surrounding us?
Yeah, I know it's an old trope, but again, it's in situations like this that diversification pays off in your portfolio. When you look at it versus equities versus bonds, decide what your diversification levels are based on where you are in your life cycle and your risk tolerances. And then once you're there, just sit tight through these periods of volatility. When you're looking at where you're positioned in the yield curve, you can't pick. Don't try to pick where interest rates are going, especially in this environment, because one day you'll look brilliant, the next day you'll look like an idiot. You haven't done anything. We find the best thing to do is to look at value measures. And Shweta will touch on a few of the value measures we use when we're structuring our SMAs.
Okay. Sure, Chris. Really quickly, on a high level, there are 4 measures that we look at in terms of, risk vectors. And so let's start with muni treasury ratios. They are actually looking very attractive. So 5 to 10-year muni treasury ratios now are in 90% camp. To give you an idea, the long-term average for these ratios are around that 75, 76% range. The slope of the curve. This is something Chris and I monitor pretty rigorously, right? The scenarios that Chris has outlined argue between stagflation and recession says, hey, the yield curve is going to get steeper. Currently, if you look at the treasury curve, 2/10 are today, as of today, it's around 47 basis points, and the long-term average is 100 plus basis points. So there will be some steepening there. Similarly, on the muni front, 2/10 as of today, 42 basis points. Again, year 2 long-term average, 100 basis points. So there's plenty of room for the curve to steepen. In addition, I briefly had touched upon credit. In credit too, we see sector selection is where you will add value to your portfolio. Curve positioning, last value metric that I'm going to talk about. Listen to this example, actually. I think that it'll clarify what we're saying with regards to curve positioning and why being an active allocator along the yield curve is really important in this environment. So currently, by owning 5-year, either muni or treasury bond as an investor, you receive anywhere between 92 to 95% of income with only 55% of duration risk. So the current environment truly puts the active part in active management.
But is that 95% of a 10-year?
Yes, 95% of a 10-year. Yes, exactly. So, the bottom line from the fixed income team is this. We think fixed income looks attractive, but volatility is here to stay. And fixed income can offer protection in the form of diversification, but also remember in this current environment, you are getting income in the fixed income piece, and that not all fixed income is created equal. So we advise for conservative high-grade portfolio with active credit picking and active allocation along the opportunistic part of the yield curve. Thank you.
Thank you, Shweta and Chris. Let's move over to our domestic team. Rob, what are your thoughts since the election and the impact on the market?
Yeah, so just like the fixed income market, Washington policy has been almost the whole story of what's going on in the domestic equity markets. I think what we learned over the last month or so is that there's been a narrowing of potential policy options out of Washington. So, if you think back to early April, the headline numbers were some pretty big tariffs, which suggested maybe a pretty big shift in global trade. We've moved back from that. There'll be some tariffs, but it's going to be a more moderate level than we thought it could be a month ago. And then also Doge and the cost cutting, like that was, a month or two ago, that was pretty. There's tons of actions. It seems that that's slowed down. Probably less government action there. And so the question is, where's the new focus going to be? I'm sure this is a pretty active administration. And so, will it be, higher education? Will that be the new area of focus? And along with that, there's healthcare or scientific research, immigration or judicial versus executive power. Like these are all possible areas and shifts in focus for the administration. So we're thinking about trying to figure out how the moderation or intensification of government policy. We look at public opinion that matters a lot, and then also inflation and the interest rates. Like those should be governors of where Washington can go with their policies. So when Trump was elected, it was there was a question of what's the mandate from the voters, and there was a wide range of options, and there was do we want a complete overhaul of the government? Do we want to rework the global economic order? Those two options seem they seem off the table. Like there could be some changes, but the most extreme scenarios aren't happening. The equity markets really like that. And so now it's maybe this kitchen table issues, grocery prices, and those are hard things to fix. And so because of that, I would kind of think the government would have to focus on some other areas to focus headlines elsewhere. But all this volatility creates opportunity, and we'll keep our eyes out for big moves and what opportunities arise.
Thanks, Rob. Staying along the same lines of tariffs, Vin, in light of the recent uncertainty around tariffs, how are you changing your approach to the global strategies?
Thanks, Michelle. I would say, our overall framework is constant over time. It's the same system that our team's been employing for, call it 25 years now, but it has been enhanced, I think, improved a bit because of these tariff curveballs and shifts in the global commerce landscape. And I'll tell you how we see it. So our framework is predicated on 3 pillars. It's the quality of a business as we determine it, the valuation of the business being point number 2, and then the third piece, which is particularly intriguing now, is sort of catalysts or hypothesis for success. And in that regard, we've been able to identify a number of companies that we think are beneficiaries, tariff beneficiaries, overall, and maybe in a sustainable structural way in the years ahead. So just to give you a sense of that, not if you're engaged in global commerce, but you're not encumbered with the uncertainty of U.S. policy and the U.S. administration, then that maybe makes you a little bit more appealing as a partner, a trading partner for everyone. Just having that being away from the noise, if you will, away from the cloud that surrounds some of the U.S. trading partners right now. So we have a number of investments in that area where we've actually improved. We think the prospects have been improved, the valuation and the investment merit has been improved. And there's actually one example in our portfolio just this week that's in the news, which is our investment in Mercado Libre, which we've written about quite a bit. We profiled it on our blog last summer. But Mercado Libre, recall, is the sort of the Amazon or the e-commerce leader of South America, and they are importing a lot of goods from Asia and selling them to the consumers across South America. And now they have these sellers in Asia that are even more eager to do business with them. So they're going to get better terms and better profitability now for their business because they're able to import products from Asia on a reliable, steady basis when these sellers are looking for new markets and better markets for their products. So Melly's we think is one of the winners we have in our portfolio and an example of a beneficiary. The point being, the equities, there's usually some silver linings in the clouds, and there certainly is in this case. If you're worried about goings on in Washington as an equity investor, our team thinks don't be terrified. There's always some interesting things to do and some reasons for optimism. That's how we see it. Back to you.
Thanks, Vin. So at this time, we'd like to give anyone on the call a chance to ask questions. We have a question that's come in for our fixed income team. What has happened in the municipal market in April and May?
It's a recovery from the January effect. And we've written about this a number of times. In the two of the biggest coupon payment dates and maturity dates in the municipal market are January 1st and July 1st. That is also, those are the periods where you have the least amount of new issuance because people are on holiday, whether it be the Christmas holidays or 4th of July summer. So you have low levels of new issue supply. They recover in the spring, especially around, end of March into April. So what we've had is in the municipal market, we've had about 4 weeks of $12 billion plus weeks of new issue supply. Couple that with the fact that we've had more volatility in interest rates and rates are rising. And that typically will drive the retail investor out of investments such as mutual funds. Mutual funds over the last 2 to 3 weeks have lost $6 to $8 billion, and that forces the funds to sell into what is already a strained market. So you've had the interest rate volatility based on tariff policy, new issue supply increasing, and forced selling out of mutual funds because retail investors want their money back. That can cause some issues that will not become apparent until later in the year, because typically those portfolio managers who are selling municipal bonds will probably be selling ones with capital gains associated with them. So if the market continues to rise in rates, investors could be surprised by lower NAVs plus getting a capital gains liability bill at the end of the year. We think, of course, that this is a buying opportunity. And as we have new money coming into our SMAs, we're putting that money to work eagerly.
Great. Thanks, Chris. All right. A question came in for Vin regarding OPEC's recent actions and how they might impact some of your investments, such as Valaris. Care to take a stab at that?
Sure. Yeah, we've written and talked just recently about some of our investments in the offshore energy space, and this is offshore traditional energy as well as offshore wind farms and wind farm development. And for sure, this is a cyclical area. And as we see it, the time to think about cyclical businesses and to be investing perhaps is on a counter is when the cycle is weak and investing in a counter cyclical kind of way. So it sure seems like 2025 will be a down year and is relatively soft for many of these companies. But wind farm development will pick up again, we think, over time, and we think that 2025 is not the typical, not the normal period to appraise the companies on a long-term basis. So I'd say look at the data looking out just a year or two. If you squint a little and consider the evidence from companies like Vestas, the Danish wind farm leader, Equinor in Norway, Rystad Energy Consultants. There's a lot of data and a lot of intuitive support for the notion that spending and activity will pick up. We think in 2026, and from there should be stronger in the next few years. So this this right now is the time to be thinking about it, and we're enthusiastic.
Ben, we have another question for you. You've written a lot about uranium in your blogs. You've been bullish on uranium, but the uranium trade hasn't been working out lately. Is it over for uranium? What are your thoughts?
No, thank you for the question. That's a good question. Yeah, so just to review, we have been bullish on uranium from the get-go for the past several years. But remember, we're multi-year, long-term oriented kind of investors. We wrote about uranium most recently in October, I want to say, and those points still hold. So, there are many points to be thinking about, but a big one is there's 190 million pounds global demand. There's only about 155 million pounds of primary supply, and that gap, roughly at 35 million pounds, it's got to be filled. We think Jung and I have talked about this extensively and keep looking at all the data. The gap's got to be filled. It means prices are going up. So if you're an investor in our global strategies, that's something we can all look forward to. And if you're an investor in uranium, on your own, I would say, stay the course. Thanks.
Absolutely. This is for our fixed income team. What are the odds of the tax exempt status of the municipal market being changed?
Shorty, you want to take that?
Oh, sure. So this is something that, at least on the muni side, this comes up every time we have a new administration in Washington. And this time, the crescendo of that is much, much louder. And like we like to say, it's not a non-zero event. We will know more in terms of what happens to the muni tax exemption as the budget gets closer. Right before actually hopping on this call on Bloomberg, there was a headline with regards to SALT, which should help with munis. Where there is this rallying for SALT cap to be increased to 30,000. But bringing it back to muni exemption, we are really hopeful that that is a non-issue this year, because the savings in terms of getting rid of muni tax exemption is not material enough to make a big dent into the budget. And we've talked about it several times before. What happens hypothetically if the exemption goes away? Well, the taxable market just becomes bigger. So we have taxable municipal market in the eventuality that this happens. And what happens to existing munis? They become expensive. They do really well in the short term. And any state or local government issuer that is looking to come to the muni market is going to, push that forward and come into the market and issue as much tax exempt debt as they can. However, the bottom line truly is the material savings from getting rid of muni tax exemption is not high enough. This does circulate in the headlines in news media a lot. And for us, at this point, it is just a headline risk that sort of has this overhang on munis, with the possibility of this happening is really, really low.
Thank you all for joining us today. And as always, please reach out if you have any questions. Thank you.